The title of my talk is Natural Rates of Interest and Sustainable Growth. And let me amend that too, natural rates of interest and genuinely sustainable growth. And as you'll see, I'll distinguish between that and the sort of sustainable growth that the Federal Reserve achieves regularly in each boom, okay? Let me start, though, with some stock taking and a little reflection about macroeconomics and policy prescription. What passes as high theory today is something called stochastic dynamic general equilibrium analysis, SDGE. I invite you to Google those letters and see how many hits you get. It's enormous. That's what macro is all about in the higher echelons of academics today. That's high theory. It removes itself from policy discussion. It's just all too sterile for that. So workaday policy discussion takes the form of old-style stimulant packages, fiscal and monetary, of the sort that would embarrass Maynard Keynes himself. Well, it turns out the market is a process. We hear that a lot from advocates of markets, and we can add, so too is theorizing about it, which raises the question, how far back do we have to go to start all over again? My suggestion is we need to go back to Ludwig von Mises' theory of money and credit, which was written in 1912. The date itself has significance as being the immediate pre-dawn of the Federal Reserve System, and the title concepts, money and credit, align perfectly with today's panel. Now, the key issue for Mises of credit misallocation refers to the allocation of resources within the macroeconomic aggregates that populate modern macroeconomic developments. Alan has given us a good sense of the dual goals of the Federal Reserve and the trouble that the Fed can get in by using first one and then another. I can deal briefly with this issue to say that the idea of credit allocation, of resources within the aggregates, just gets totally overshadowed today by the obsessive attention to the two magnitudes, unemployment and inflation. So if interest rates are manipulated with an eye towards reducing unemployment or reducing inflation, then just by construction, they cannot be at the same time consistent with the allocation of resources that gives us genuinely sustainable growth. So the sustainability that the Fed actually does achieve, strictly and perversely, is what I call between crisis sustainability, which is to say that it manages to forestall corrections, extending the boom, but of course making the eventual crisis more severe than it otherwise would have been. To avoid the crisis, that would be the more genuine concept of sustainability, to avoid the crisis to start with, the interest rate in its role of allocating resources within the macroeconomic magnitudes would have to be high on the Federal Reserve's agenda. Now, I'm certainly not advocating here that we need to give the Federal Reserve 3 mandates instead of 2. I'm just showing you that by totally ignoring the rate of interest that would equate savings and investment and align investment decisions to saving decisions preempts any possibility of having genuinely sustainable growth. I wrote a paper a few years ago that relates this to the Taylor rule that I think is worth repeating in a very condensed form here, where supposedly the Fed splits the difference in some proportion, usually binging in one direction or the other, as Alan suggested, but it splits the difference between fighting unemployment and fighting inflation. And I've described this as an ill-fated learning by doing strategy. And the reason it's ill-fated is because the doing occurs about once every 8 weeks when the policy committee meets to decide what to do with interest rates. That's the doing. The learning occurs only about once a decade when the economy is treated to still another crisis, okay? After which it starts out on another learning by doing strategy. Now, what's missing from the Taylor rule, of course, is any notion of the natural rate of interest, what it should be in order to allocate resources in accordance with people's preferences. Let me remind you that the natural rate of unemployment, a term that we're all familiar with, in fact, is hardwired into all macro theory and all policy discussions, was the basis, or was set out by Friedman on the basis of the complementary distinction of the natural rate of interest. In other words, he cribbed from Knut Wicksell, the Swedish economist, the idea of a natural rate and said we could apply it to unemployment as well as apply it to the rate of interest. The natural rate of unemployment was initially defined by Friedman as the rate that's ground out by the system of Walrasian equations. It was eventually and fairly soon softened up simply to mean the rate of unemployment that's consistent with the real forces in the economy as opposed to the monetary forces. Now, unfortunately, those two complementary natural rates of unemployment and of inflation weren't exactly kept together. Instead, all concern about the natural rate of unemployment simply swamped any concern about the natural rate of interest. Keeping both interests or both natural rates in play reveals a critical trade-off that we ignore only at our peril. Let me offer a simple setup, overly simple you might say, and it probably is. Suppose that inflation is not a pressing problem. Well, that's quite a supposition to start with, but let's suppose it just for the sake of argument. But suppose that unemployment is. We have the unemployment rate above the natural rate. Well, straightforwardly, the policy prescription is for monetary ease, for reducing the rate of interest, all right? But now let's make one more supposition, and that is that suppose the old interest rate was, if only willy-nilly or happened so, at its natural rate. Well, that means that to try to solve a labor market problem, you create a credit market problem. This is something that the Federal Reserve seems not to give much attention to. So the Fed, in lowering interest rates, drives a wedge between saving and investment. And more importantly, certainly in the Misesian point of view, it's not just that the aggregates are misaligned, it's that resources are allocated incorrectly within the aggregates. The term I like to use is differential interest rate sensitivities. Some prices of assets go up more than others. Allocations in some areas go up more than others. Durable capital, including housing, durable consumer goods, time-consuming production processes, are all favored by a low interest rate that's lower than the natural rate of interest. That's what gives you the malinvestment that Mises talked about. The malinvestment caused by the monetary policy is typically categorized as structural unemployment in today's macro discussion as being something apart from monetary policies. Not so. That kind of structural analysis is very much a part of the upturn of the business cycle, and it's also a part of allocation during a recovery. Now, I'll recognize that the Fed sometimes does worry about rising asset prices, asset inflation, it's called. a kind of inflation that doesn't show up in the consumer price index, which guides their choice between fighting unemployment and fighting inflation. And yet, the Fed abstains from trying to control asset prices, even though hinting that it might have to. It abstains from it, choosing to leave it to the market itself to determine what those asset prices should be. Well, good. We're happy about that. But my question is, why don't these worries about asset prices being too high transform themselves wholesale into worries about the interest rate being too low? That's a price, the interest rate, that they don't leave to the market to decide. It's an incongruity to say that, oh, they will control interest rates, lowering them to 1% or 0% if need be, but not control asset prices. Of course, I think they should not control either. I'm not advocating more control, I'm advocating less. Now, what I want to do, and I'll make it short because I'm aware of the time constraint, is distinguish between two recent booms, the dot-com boom and the housing boom, and show you that typically, not always, but typically, Fed-driven booms ride piggyback on real booms. The dot-com is a good example, where we have an increase in the demand for credit to take advantage of all of the innovations during the digital revolution. And that increase in the demand for credit would, guess what, cause interest rates to rise. Well, fine, interest rates should rise. They should rise to a brand new natural rate of interest that reflect actual underlying economic realities. But, as is typical, the Federal Reserve doesn't let them rise, or at least doesn't let them rise as much as the market would cause them to rise. It's not that the Fed is stimulating, wouldn't think of itself as having stimulus packages, it would just think of itself as accommodating. But accommodating at what rate? At the old rate before the new profit opportunities? I don't think so. At some higher or lower rate? Well, what rate and how determined? The only persuasive answer is that it should be is that the demand should be accommodated by the market, not by the Fed. If the Fed accommodates causing prices not to rise, causing interest rates not to rise as much as they otherwise would, then the interest rate is below the natural rate. You get the misallocation. You get the Fed-driven boom riding piggyback on the real boom. Now, the recovery from that wasn't so bad, partly because there really was a real boom. And we could fall back on that real boom and the economy could get going again. I contrast that, very briefly, with the housing boom, because here you didn't have innovations and new profit opportunities in the same sense. You had a distortion of credit markets attributable to Fannie Mae, Freddie Mac, and Barney Frank. Okay, and because of that, you ended up with a Fed-driven boom riding piggyback on a misallocation of resources. And once that boom collapsed, then you had double trouble in trying to recover, because at the same time the economy was recovering from a housing bust, it also had to recover from a Fed-driven boom. Let me then conclude very briefly. And say that some have suggested that the solution is obvious, that the Fed ought to target the natural rate, give them just one mandate, target the natural rate. But of course, that's much too facile. It's a misunderstanding of what the natural rate is. The natural rate of interest is a rate that would emerge on the market without there being a centrally controlled money supply and credit market. And once the market discovers that, it doesn't need a central authority to approve. Okay, so that's the case essentially for going to a decentralized banking system. Mercifully, I don't have to tell you just how to get there, because our panel after lunch will tell you all about that. Thank you.